In this video, I'm going to be guiding you through Chapter 7, Market Equilibrium. The definition is when price and quantity demanded by consumers are exactly the same, or equals. At this point, the market is cleared, also known as the market clearing price. This is when there are no unsold goods or no frustrated buyers. And on the diagram, you can see that the equilibrium when the demand curve intersects with the supply curve here. So this is the effect on the market equilibrium when we start shifting demand or supply. So for instance, if demand increases, the equilibrium price rises and the equilibrium quantity rises. Let's have a look. So when the demand increases from D1 to D2, you can see that the price increases from P1 and Q1. So this new equilibrium here is formed. If supply increases, then the supply will increase from S1 to S2, the price will fall from P1 to P2, and the quantity will increase from Q1 to Q2. And a new equilibrium is formed. Excess demand is when there is more demand than there is supply. So this occurs when the current market price is set below the equilibrium price. Now, as the price is set from PE to P1, you can see that there is a movement down along the existing demand curve from here to here. As you can see, the quantity demanded increases from QE to QD. This is due to a more attractive lower price, and therefore more consumers are willing and able to buy it. And at the very same time, there is a contraction of the supply curve from here to here. And as you can see, the quantity supplied was originally at QE, and this falls to QS. And supply has fallen due to the lower incentives of making profit. So you can see that this line here, which is the difference between QD and QS, and that gives our excess demand. So the calculation to this is QD minus QS, which gives us the red line. So the result of this in the free market, the shortage forces buyers to bid up the price, and then the price will naturally rise until it reaches equilibrium again. In the case for excess supply, this occurs when the market price is set above the equilibrium price. And at these price levels, suppliers are more than willing to supply their product to the market as they are receiving a higher price of P1. But at the same time, demand falls, which causes an excess supply. So the same logic applies here. So this is the quantity supplied minus the quantity demanded, which is here. And the red line here represents excess supply. So if the surplus of unsold stock will force the producers to lower their prices to clear the inventory. And then the price will naturally fall until it reaches the equilibrium again at QE. I hope that helped. I hope you guys have a good day. Bye bye.